Hi, dreamers. I had someone comment recently, how do you stomach having individual company stocks instead of having ETFs? And as soon as I read it, I was ablaze with thoughts. It's actually a really important question, and one everyone should answer in order to know if it's the right strategy for them before doing it, especially with the elephant in the room of a potentially sideways or down market over the next year. It's actually a great time to ask this question of yourself. And maybe you've even been watching my videos and curious, but still sitting on the sidelines, not sure what your strategy should be. And hey, it's okay if you determine it's not for you, but still want to follow along to see what happens to me. So today I'll talk about how I think about it and what questions you should consider to decide if it's right for you. Let's start with a quick reminder of what I do. So as you know, I primarily hold individual stocks and REITs, and in total I have 78 individual positions. Now I do have ETFs, and you can see them in this orange color. I have Devo, VNQ, BBN, SPHD, VTI, SCHD, VU, and VGT. But when you add all of those ETFs up, they account for less than $10,000, which is just about 0.5% in my portfolio. So not very much. So how do I stomach investing in individual stocks and not get rattled in this volatile market? First, I do research, definitely up front, but then I also pay attention at earnings calls and read about the overall macro environment. What am I looking for up front? I'll tell you exactly what I'm looking for. For every stock, I'm asking, what is the dividend yield? My sweet spot is 2 to 5%. And anything above that is gravy. I'm asking, how long have they been paying the dividend, and have they been growing the dividend yield? My sweet spot is 25 consecutive years or more, growing the dividend for at least 10 years or more, and having a solid 5-year dividend CAGR. My target is around 5% or more. Then I ask myself, what's the beta? And beta is one measure of how volatile the stock is. My sweet spot is to pick stocks that have a beta of less than 1. And lastly, I want to know, do they have enough cash on hand to pay for the dividend? And so I'm always looking at the payout ratio. The absolute best is something in the neighborhood of 40 to 60%. That's what I find acceptable. And you definitely don't want to see things like 100% or more. That's when you start to get nervous that they may not have enough cash flow on hand to continue to pay your dividend. In addition, I'm looking for a strong outlook for the next 5 to 10 years, solid management, a strong moat, and I really like regulated industries and things that people can't easily turn off, like utilities, cell phones, cigarettes, banks, and insurance. So, this is the part where you should be asking, if you don't like doing this kind of research, or you don't like keeping up with it, individual stock picking might not be right for you. Or you may decide to stick to tried and true top performers like dividend aristocrats and not venture into more speculative picks. The next way I stomach individual stocks is to add in diversification safety nets. And so the first way is simply to have 78 different companies in what I call a long tail strategy. The next way I diversify is in sectors across communication services, consumer staples, healthcare, real estate, information tech, financials, and more. And the last way is to diversify across geographies. Specifically, I'm targeting Canada, the UK, and the US. The next way is to rebalance whenever a position gets too big or an industry representation in my portfolio has gotten too big, which can happen when an industry gets too frothy, like what we saw with tech late last year. And you can see how I think about it in my Level Up video. I also may decide to undrip, to direct money elsewhere. And for example, this is happening right now with MO and BTI as a way to control where I put my money next. I also stomach individual stocks by being a long-term investor. As this article points out, Having a winning portfolio in the short term is akin to flipping a coin. But when you look out 20 years, the probability of making money is 94%. Here's another chart to think about that. If you look at the total returns of the S&P from 1872 to 2018, you can see the wild swings up and down year to year. But if you zoom out across that entire time frame, you can see the different types of means that give you a total return of about 6.8 to 8.4%. So the takeaway here is the longer the time horizon, the greater probability of success at around a 7 to 8% range. And I want to cover one final way I stomach investing in individual stocks. It's really a personality thing as well. I am not easily spooked, and I educate myself to stay that way. I understand the ebb and flow of the market, and I expect it to go up and down. Half of the battle is expectations. If you expect a stock to go down because a Fed meeting happens or an earning release, you're not as concerned because you are anticipating it. You know why it happened, and you know it's only temporary. So that's one reason why I always encourage at the end of the video to put your learnings into practice, because the more practice you get, the more experience you get, and you get used to it. But hey, this is a good gut check. If you are easily concerned and you know you are likely to sell low when things get rough, this absolutely may not be a great strategy for you. And in that case, I might advise getting a financial coach to help you make good decisions along the way. So, overall, my answer to how I stomach individual stock holding is the upfront research helps me understand why to hold it. Keeping current helps me understand short-term blips. A long-term view makes the probability of success go up, while diversification makes my risk go down. All of that plus expectations help keep me calm, and a disciplined strategy of rebalance and drip reinvestment keeps me feeling in control. But I'm not against ETFs. That is also a good strategy, especially if it's broad-based S&P 500 ones like VTI, VU, or SCHD. That's what I love about investing. There's no one right answer. And over time, I may even go towards ETFs once my income needs are met. So do what makes you feel comfortable. All stocks, all ETFs, or maybe a hybrid of the two. All right, guys, thanks for spending time with me today. As always, I encourage you to keep learning, implementing, do your research, and then put it into practice. And as a reminder, I'm not a financial advisor, so keep in mind these videos are for entertainment and inspiration only. I'll see you on the flip side.